Hi, everyone. I'm Rick Bensignor, and welcome to this week's In the Know Trader Show. Well, as we record late Tuesday morning, the S&P is down 22 points, making new lows on the day, down to 33.58. As finally some trickle through from China is affecting U.S. companies. Apple reported over the weekend that they are going to have lower guidance. And finally, you're seeing a day that the market's taking this into effect. And although the S&P is still not even 1% or so from its all-time high just made last week, we are at least seeing some type of decline and trickle through. And you certainly expect that. Bonds are getting bid up. Yields are falling. The 10-year is down to about 1.54% or so. Gold is having a good day. April gold is over $1,600 now. It's up $21 on the day at 1608. So that is approaching the highest high that we had seen on the spike up in January when Iran bombed Iraq. So this is good for the precious metals. And even something like platinum's up $25 today. Palladium, a very thinly traded market, up $179 an ounce to just about $2,500 per ounce, the most precious of precious metals. Just very few people know about it, and very few, and even far less people trade it. Whole volume on the day is only 6,200 contracts. So today, before we do it, let's just how to contact me, Rick at intheknowtrader.com. Of course, our website, intheknowtrader.com, has lots of videos, information on how to sign up to be an In the Know Trader client. We come out Wednesday nights with our weekly report for individual investors, and we review everything that's going on in the market, plus give a new ETF recommendation each week and follow up on every other open trade idea we have until it's closed out with either profits or getting stopped out with hopefully a small loss. So intheknowtrader.com is the place to find out more. Today we'll take a look at the relative performance of the sectors week over week. We'll of course look at what the market's doing and the charts of the S&P on a daily and weekly basis. And today we're going to focus on the utility sector because it's been doing rather well. It's outperforming this year. And we'll look at a bunch of the biggest names in the space, crossing all the different segments of utilities. But this is a sector certainly that's moving, doing well, and we haven't looked at these in a long time, so we'll take a look at as many of these names that we can in the time we have. One thing I wanted to do just before we get into looking at charts and stuff is take a look. This I grabbed off of CNBC's website, and it's the outlook by the top strategists on the street working at major sell-side firms, and where they project the S&P to be year end. And notice I circled on the bottom, the average target for the S&P December 31st is 33.68. We are currently trading at 33.60. So, you know, the reason I bring this up is we've gone as much as the average analyst on the street thinks we're going to get for the whole year, and yet it's only February. So my guess is, as often, the average targets aren't going to be very accurate when it comes down to it. In the end, you can see the high and low on the street. The high comes from Credit Suisse. The low, Mike Wilson at Morgan Stanley has the S&P closing out the year at 3,000. So that would be a chunk lower from here. So obviously he's looking for a very weak year as things go on. But interesting that it's February and we've already hit the target. The median target's 3,400. We got within, I don't know, 15, 20 points of that or so last week. So just, I bring this up because you have to understand how the sell side works and how strategists work on the street. Similar to analysts, when they have targets that get hit well before they thought, they generally need to reevaluate and they'll change them. The fact that we've already hit as good as most people think we're going to get on average says that you may very well see some updates as the year goes on, because I think a lot of these people didn't expect the market to start off and gain as it did to start the year. So anyway, that's my thought on that. Let's move to comparing week over week, what's moving in the markets. And only 2 of the 11 sectors this week have moved more than 1% different than where it was a week ago in relative terms to the S&P. Those 2 are highlighted with green dots. They are the utility sector, which is now the second best performing sector on the year, up 4% as of yesterday's close relative to the S&P. And then real estate also picked up nicely this past week. So that is up now 3.4% coming into today relative to how the S&P is year to date. And so you kind of notice that besides the tech sector, the real movement here is coming in utilities and real estate, which are both considered yielding parts of the market. In other words, investing in the utility sector. Most people do it for the yield that you get, because these are typically high yielding securities. And of course, the REIT sector also pays off with dividends and typically higher yields than other parts of the market. So as the US 10-year and interest rates in the US move lower, these sectors tend to do better, and that's what you're seeing. So if you're looking for a place to get in the market that offers some yield, and you're not terribly bearish on bonds, meaning that you think interest rates will still stay generally low, then these are the sectors to look at for 2020. And you can see just even in the last week, the large type movement that you can get in these when rates start moving down. So these are a defensive sector. These are a sector that get a bid when people are continuously bullish on the bond market, which is another way of saying bearish on interest rates. And with the 10-year at 1.54%, we're only about 9 basis points above last year's low. And you start getting into what has been a triple bottom in yields going back to 2012. So I think it was 2012, 2016, and 2019 that within 10 basis points either side of 1.45% is where you've seen this kind of somewhat longer term triple bottom. If the all-time lows give way, then my next target down in yields is 1.25%. And if bonds kept going, which would start then indicating potential recessionary type of qualities to it, the next level I recall seeing was at, I think, 0.98%. Yield. So need to keep an eye on that. On the upside, yields need to properly get above 1.9% in order to break out to the upside. They got as high as 1.96 last year, but did not break out with a qualified and confirmed breakout. For those of you who are new to this podcast or are not in the No Trader clients, that is a filtering process developed by Tom DeMark that I use to some degree in order to determine if a move is really a clean breakout or if it's more likely to be a false breakout. So again, even though yields got above 1.90% last year, they did not get it in a clean breakout way, and therefore you essentially have a failed breakout above 1.9, and that's led to a move all the way back down towards the lows. Okay, let's move to some charts. Let's look at the S&P. All right, so here was the mid-January sell-off when coronavirus first hit. We got down to 32.25 in the S&P, which is what our minimum downside target was, came back, made new all-time highs by a little more than 1%, marked a setup 9 count last week, which may or may not be meaningful at this point, and you're seeing some pressure today. For short-term levels that are important, 33.34. If we properly break that, it would suggest that we would get down to 32.82 next. Basically, to me, as long as we're above this trend line, we're probably okay. And this is all just kind of part of minimal backing and filling of the market. Obviously, Thursday of last week made the all-time high up at 33.85. So again, we're trading at 33.60, 25 points, not even 1% off all-time highs. So that picture still nothing of significant issues. The weekly chart, we're still within this upward channel, and we suspect that over time we'll ultimately hit the upper end of the channel. But we're still within the context of an aggressive combo 13 signal. This is a sister model to sequential. It just counts differently how it gets to the 13s. But if you look in the past, so in the summer, or actually the spring of 2019, this upside exhaustion signal came in and we sold off for several weeks, and it took several months before we actually went higher than that. Look back to the summer before that, in the summer of 18, upside exhaustion at what again was all-time highs, and then a much bigger decline. So this signal doesn't get stopped out until you get properly above 33.94. If this week closed down on the week relative to last week, and then next week closed above 33.94, and the next week gapped higher on the open, then you'd probably have an upside breakout. Otherwise, we're still kind of within the context of this upside exhaustion signal. And I don't mind buying a little bit on pullbacks, but I'm not going to be a big buyer, just because history tells us that signals like this often give you some sense of a pullback. Now, when we got it, we certainly had a sharp 2-week pullback, happened to coincide with coronavirus issues first coming and hitting into the market. But to me, we're still within the context of that. And we'll have to see what other companies start giving us a clue that the problems in China, are going to trickle down. You have lots of U.S. companies that do significant business in China, Starbucks, McDonald's, to name just a few, but there's lots and lots of them. And with a heck of a lot of the country kind of closed down, it's going to be hard for our U.S. companies to post results that would have been in line with earlier guidance. So, Apple may just be the first of many that ultimately are telling us that there are going to be some significant issues with China-related sales. And you also have like the auto parts industry, which gets the bulk of their parts from parts made in China. And if they can't get their parts, then you're going to see weakness here in these because they can't sell what they don't have on hand. So again, I come from the personal point of view that the coronavirus is a bigger deal than a lot of the press makes. As I've said before in prior podcasts, I don't trust the information that comes out of China. But to some degree, I can't 100% trust even the information that comes from Western nations and our own government, simply because they're never going to say that this is a major problem, in the sense that they don't want to create panic here. And I get it. But from sources I have that so far have been spot on in everything they've told me about coronavirus in the last month, I just have some concerns that the marketplace isn't taking this seriously enough. And as I've said on, I think it was this podcast, but certainly in the last 2 weeks, twice I've been on 2 different Singapore media stations, one a TV network and one a radio show, is that it may take, and I say this in just the way I'm thinking of things, it may take U.S. investors literally having to see an American die on U.S. soil from coronavirus before they take it more seriously. Kind of like, we feel bad for what's going on in China, but it's not our problem. Well, it certainly can be a problem. I think it's only a matter of time. It's not when it's going to hit the U.S. It's going to be more of like, or it's not if, it's just a matter, better said, it's not if, it's just when. And, healthy people generally are not going to be, even if you pick this up, it'll be more like a cold than anything else. But my feeling is that when this gets here in a bigger way, that then you'll probably see people reacting more concerned in the market than they've been so far. But I think today's kind of an important day in the fact that such a large cap company like Apple made the announcement over the weekend that, you know, what's going on in China is going to influence forward results, and I suspect we're going to see this from some other companies too. So hard for me to be a big bull up here over time. Yes, I'm bullish the market over time, but I just think there's probably better entry to get into than, you know, north of 3350 in the S&P. So that's my take on that. Okay, so now let's get, oh, by the way, what the heck, might as well, let's take a look at gold just because I mentioned it before, just how well it's doing. So where gold is trading now is the highest. If we were to close here, this would be the best weekly close. Go back to $13 is the high for the year. And so gold continues to move higher as we've expected it to. We have a minimum kind of this green line here, $1,700 target is what, if you look at the entire rounding bottom in gold from 2013 to 2019, I kind of put the breakout somewhere here. These purple lines represent where the breakout comes from. I kind of put it at 1375. The low is about 1,050. That's $325 worth of maximum height. Add that to the breakout. That target's 1,700. And it doesn't mean it has to stop there, but I think gold, you know, still has room to go. I'm long, and for institutional clients, we're not long gold bullion, but we're long gold stocks, and it's doing quite well. So that's kind of the way I'm playing this. Now let's take a look at the utility sector. So let's just start with XLU on an outright basis. This will be a chart of the S&P 500 Utilities Index. Okay, come on up. There we go. So I'm going to bring in some more data here. Clearly, this is on all-time highs. So we're literally trading on all-time highs as we speak. Again, we mentioned that this is an outperformer this year. We'll take a look in relative terms shortly. But this 13 count here has been stopped out. This prior 13 count got stopped out. So, you know, I still think there's more to go here. Utilities, again, are defensive. And as rates come off, this sector is going to do well. What's the first level that I would even have any concern for would be a qualified and confirmed Friday close beneath 68.50. That level has just gotten printed this week as a new level, as a new reference level based upon how the market's moving now. So as long as we stay above 68.51, and we don't break beneath it on a qualified and confirmed basis, then this is still a sector to be in, and I don't have any material concerns on an outright basis. Let's switch this over to XLU divided by the S&P. So here's relative basis on a weekly chart, and you can see multiple bottoms here. Let's put a trend line in. So going back to early spring, late winter, early spring last year, you can see 1, 2, 3 times we kind of got to the same level. You can see that this vertical line here is the start of 2020. So utilities have outperformed. They're off their best performance of the year in relative terms, but it's outperforming. I think right now this is a sector to be in. And just looking at this chart, go back here too. There's no one particular high, but we look here, and this would suggest to me that, you know, there's still room here on the upside for this chart to go before it would run into some prior resistance. I actually want to bring some more data in here. So I want to look at, there's potentially a sense of an inverted head and shoulders here that's developed over the last couple of years. You'd have to, my guess is you'd actually have to cleanly break out above this level here at 89, just about 22.9, which means the price of the XLU is, you'd need to get it above in round numbers, 23% of the price of the spider to get a breakout on the upside. So I like it now. I think we'll still trade higher, and I suspect in the coming month or two, there's a decent chance, as long as rates stay somewhat suppressed, that this is going to move up and outperform the S&P. So, MACD, look at the bottom here. MACD is in positive shape. Triple bottom here makes me think, yeah, we're coming back into this zone here, and probably need to get above there to get a clean break to start playing against higher levels from the past. So that's utilities on a relative basis. Let's now take a look at some of these key bigger cap utility names and go through them one by one to see if there's anything that we can discern from the charts, let alone figure out which one of these dozen or so are better than others, because I'm going to want you to look at this in terms of kind of how I do. When I pull up a chart, the models you're seeing now are basically the models that I'm going to start with. I can always add to it, but I'm going to have DeMark's sequential model on. I'm going to have Ichimoku cloud chart on to give me a general sense of underlying trend. And then I'll also have, let's say, propulsion on along with MACD. So propulsion is more of kind of an indicator that works on the physics of the market with thrust. So it would suggest, for instance, if we got through, let me find an example. Well, it's a little hidden here. If we got through here, it said we would get through to these blue triangles. If it gets to the blue triangles through there, then it often would suggest that there's enough thrust to get to the green ones. And, starting back in just January of 2019, looking at this, you get the signal, it goes through, it finally goes through there, it takes half a year, but yes, eventually we do get to those levels. So this is the basic way that I'm going to start with a chart and look to see what's going on. So we see here we're on all-time highs. We've moved well past the 9 count, which is sometimes a temporary holding point. So NEE, Nextera Energy, which I believe is the largest cap name of all these, still looks good. If I'm looking to buy, I could buy a little bit at 272-ish and a little bit more at 280, and I'm not concerned until we get, let's say, beneath the baseline from the Ichimoku cloud chart, which currently is at 250. So for now, it's a name that clearly is getting good upside momentum, and I think is, again, a relative outperformer, a good place to be. Let's look at SO, Southern Company. And now this one, I'm going to have a little less willingness to buy right here, right now, and that is because of the 13 and 9 count that showed up the week that it actually had a decent down week. Notice the last time this had a signal is back here. This is a buy signal, or essentially downside exhaustion to the trend. Way here on the left was an upside exhaustion to the trend. So look at the last 2 of 3 signals. There's a 13 in here that did not stop the trend. So it was an early indicator that did not work. It would have gotten stopped out closing above here. But look, this gave me indication of upside exhaustion, and it was a good indication. This gives me an indication of downside exhaustion, and it was a very good one. This gives me an indication of upside exhaustion, did not work. Now we have another one. So the good news is the recent sell-off held against where the new propulsion sell signal would kick in. So Friday closes underneath 68.04 that occur after a Friday close that was an up close. So just for instance, if this week turned around and closed under 68.04, then I'd have concern that this could get down to 65. Otherwise, this is a good name. I just don't want to probably be a buyer right here, right now, just simply because of this level. You'd have to get above 72.66 to stop it out, but I would look for pullback. If we got to the mid-60s, so let's say the whole market pulled back and it just dragged utilities with it, even if utilities were an outperformer in the process, I'd probably look to get into this at around 65. So that's how I place Southern. Next is Duke Energy. Duke Energy also on a 13 count from last week. Again, I'm going to look at some prior 13s to see if it's caught the kind of the right mode and feeling for the market. This did. Upside exhaustion took months for it to get above that level. We've got some 13s in here. Also took over a year. So this makes it a little hard to be a buyer right here, right now, but I may even cut this down, let's say, to a daily chart and take a look for initial support on the daily chart to figure out where to come in. But on the upside, there's room up to 112 over time. So I like it. I also like that we bounced on the cloud back in the fall last year. So again, another name I could buy on weakness. I could buy a little bit here, but certainly wouldn't buy a major position, buy on weakness. But ultimately, I think this is going towards 112. Dominion. A couple weeks ago had a 13. We're on an 8 count already. So now here, notice this 13 didn't stop it. This 13 didn't stop it. We are up against, or actually, no, we've moved through those prior highs. So this has room to 90, but it's trading 88. So to me, doesn't have much upside. There's probably better names to buy than this one. So just in relation to other names we've already looked at and those we're about to look at, I'd say there's probably better names than Dominion to get into if you're looking for exposure in utilities. Here's AEP. American Electric Power. So let's see, again, a run of 13s that really didn't. This is the only one that caught a little bit of the pullback. I'd say I'd be a buyer near 99-ish on a pullback with a target at 112. So that's you're kind of halfway in between either now. So again, the only good news is that the pullback held and didn't break the propulsion level. So I give this a minor bullish bias at this point. I mean, obviously the longer term chart's bullish, but as far as doing something right here, right now, same thing, maybe a small piece, wouldn't put a full position on. Sempra Energy, SRE, you'll notice several of these are looking similar. Big breakout move in 2019. This 13 count kept us sideways for about 2 months. This 13 count didn't really do good at all. And now we have a 9 count. And we're close to, I have no higher level to project to. Oh, well, actually, we have this one here. So bigger upside target is 168. It's already 161.5. So yeah, you could still get a few percent higher, but not a lot of room before some of these targets. So again, maybe some better names than the last two that we've looked at. Let's take a look at XL Energy. So also, you know, like most utility names have been ripping. This I actually like more because there's more room to the upside here at 77 and change. Put on a little bit here, put on a little bit more in the upper 60s, play for the upper 70s. So that is one of the better names the way I'd look at it. Con Edison. Pullback buyer near 91-ish if you got the chance. Upside targets include 98.5 and then way higher at 112. So this is stalled. This is not on the highs the way some of the other ones are. It's certainly close, but again, down near 91, if we got a couple percent pullback, I'd like it. And I think that's all we're going to have time to do for today. So we got about 10 names in or so. And thanks for listening. I'm Rick Bensignor, and this is In the Know Trader.